Hey everyone, welcome to another dividend stock investing video. I have an exciting video today. I'm going to cover Johnson & Johnson, which is splitting into two companies. I want to cover IBM Kyndryl. IBM recently spun off Kyndryl, and I want to cover Realty Income, which recently spun off Orion Office. All three of these parent companies are undergoing companies splitting apart or spin-offs. And I want to share in the video today my general philosophy, how I approach spin-offs as a long-term dividend stock investor. I have so much ground to cover, everyone. Get ready for a really exciting video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to jump right into some statistics on the stocks just mentioned, and then I'm going to get into a whole bunch of slides and information. I have detailed timestamps in the description below so you can follow along at home. So check it out in front of you on the screen right now. You can see some statistics about JNJ, IBM, and Kyndryl. Now, honestly, in this video, I have so much ground to cover. I decided with Realty Income, Orion, I'm going to cover that in a bit more depth in a future video, but I will touch on that in the video today as well. Johnson & Johnson right now is trading at 162.66. This is my number one favorite stock of all time. It's my largest holding in terms of dividend stock portfolio, and I continue to add to this stock on a weekly basis. In fact, I've purchased Johnson & Johnson 6 weeks in a row right now. My patrons already know about that because I share all of my stock trades over on Patreon. Check out the pinned comment below for more information about my Patreon. Now, J&J right now, in terms of analyst estimates, is going to earn $9.80 this year, $10.38 next year, and that places the forward PEs at a 16.6 this year, 15.67 next year. I go ahead and I highlight those particular price earnings ratios because I believe Johnson & Johnson is trading at a bargain basement price. In fact, this is one of the reasons I think management is looking to split apart the company, because I think they're trying to unlock shareholder value. In this kind of market where PE ratios are for world-class blue chip companies, I think management is looking at J&J and they're like, hey, this shouldn't be at a PE of 16. It should be at a PE of 25. And I think they're trying to accomplish that through the business split. Let's keep going. As you can see in front of you right now, J&J pays a quarterly dividend of $1.06 or $4.24 a year. That gives them a starting dividend yield of 2.61%. Not that huge, but the payout ratio is only 43%. There's a lot of room to increase the dividend, and they have been increasing it by 5.8% per year on average. Market cap is $428 billion, huge company, but could be bigger if they're able to unlock value through this split of the business. And it's my number one favorite stock. Now, what I would say in terms of goals is I want J&J to be 10% of my portfolio after the spinoff, or the business split, if you will. And you can see the stock chart at the bottom of the screen up and to the right. And so just to take a step back, and I will get into more detail about this, but to foreshadow the rest of the video, what's going to happen with J&J is they are going to take their consumer-focused business, their consumer brands, like the Band-Aid brand, for example, they're going to spin that off into a separate business. The main business, which will continue to be called Johnson & Johnson, will include pharmaceutical division and medical devices division. So my personal goal is, even after the spin-off or the business split, I want to have the main Johnson & Johnson company represent 10% of my portfolio, and that's why I've been buying it weekly, and I will continue to do so. I want to go through IBM Kyndryl statistics next, and then I'm going to get into some thoughts about each particular company. So check it out in front of you right now. IBM is trading at $116, and based on their forward estimates for EPS, I highlighted the PEs are low in the 11 range. Now, what I would say is the reason the PE is low is for a reason. This company has been trying to turn itself around for years and years, and it just can't seem to figure it out. And so I think they spun off Kyndryl in a last kind of effort, I think, to try try to turn around this business. And so you can see the stock chart, though, over the long run, at least it's up and to the right. Now, the dividend yield is a really nice 5.65%, the starting dividend yield. Payout ratio is a bit higher, though it's 67%, so I don't know how much they're going to increase the dividend in future years. And we already see that the dividend growth rate is pretty slow at 3.2% per year on average. Market cap is only $104 billion, which is tiny for a tech stock. I would say IBM, I was really close to selling it. It's an ancillary position. I almost sold it because I needed to raise money for our down payment on our new home, but I did not need to sell this particular stock. I didn't quite need it, so I'm holding. I'm not reinvesting my dividends, and I'm not adding to IBM anymore. I'm just holding. I still have some hope for their patent portfolio, and this main company, IBM, now that they've spun off their kind of consulting services business, they're going to stay focused on the hybrid cloud, if you will, and new technologies. And so I think this core IBM company, hopefully there will be a resurgence in growth. It won't be held back as much anymore by the consulting division, although I don't really think it was holding it back. I do think spinning off Kyndryl, though, the consulting division, will unlock value for Kyndryl, but we'll get to that in a minute. But anyway, I'm holding on to IBM, but if I looked at my overall dividend stock portfolio, and I own over 50 dividend stocks at this time, if I looked at the whole portfolio, IBM would be at the bottom, and it would be a contender for a sale if I needed to raise cash. Thankfully, though, I did not need to sell it, and my general rule is to buy and hold forever. And so I guess I've got some skepticism for IBM here, but that being said, we'll see how it plays out in the next decade. I want to share some thoughts on Kyndryl, and then I want to get really deep into my overall thoughts about what I'm doing, what all of this means. And so as you can see in front of you right now, Kyndryl is the company that IBM spun off. This is the consulting business, the services side of IBM. It's actually a really interesting business. Now, the price per share is $18, and you can see by the stock chart, since it's actually been spun off, it's been tanking. I love that. I love it when someone hates a stock. It gets me looking at it. I think the world hates Kyndryl right now. I don't have an earnings estimate on here. We'll get a bit into earnings later, but I just did a high-level revenue for this overview. And right now, in terms of revenues, they're on a run rate of about $19.1 billion or so, thereabout. And in terms of a price to revenue, because this thing is a market cap of only $4 billion, they're trading at about 21% of revenue. And so I think this is trading at a bargain basement price. This is the largest IT technical consulting company in the world. There's no dividend as of now, but I think once they clean up their books, they start driving a solid profit sometime within the next 5 years. I think they're going to end up paying a dividend. Kyndryl is a very small ancillary position. I'm holding it. I may add to it in a tiny manner. I think it's a bargain potentially. I like buying a bargain. I like buying something that everyone hates. There's a Microsoft partnership which just came about, which would have never been possible if Kyndryl was part of IBM still, and I think that's very promising. I think Kyndryl being a spun-off company opens up doors, and I love the overall backdrop of society going digital. Big companies that have been around a long time that are struggling with going online, going digital, going to the cloud, they need help, and Kyndryl is there to help them, and I don't think teams and managers and executives are going to skimp on those types of expenses. And so I think Kyndryl actually has a niche business which could work out really well for it in the long run. Here's what you're all waiting for. What am I going to do? Johnson & Johnson, of course, I'm going to keep both companies. There's no doubt about it. And I am building aggressively before the consumer business is spun off, if you will. IBM Kyndryl, I'm holding both of them. I am not adding to IBM. I'm not reinvesting dividends. Kyndryl, I may add a little bit to it because I just like how it's gone down. It will never be a core position, but it will never even really be an ancillary position. I guess Kyndryl is an ancillary position, but I just don't need to sell it, so I'm not going to sell it. And I think it's a team member, I guess, in the portfolio, if you could call it that. Now, with a Realty Income, which I did not show on the screen, I am holding both Realty Income and Orion. I'm not going to sell Orion, and I look at Orion kind of like Kyndryl. I may add some to it because everyone hates office space right now. They hate office REITs. No one's going into the office anymore. Fewer people are. That makes it attractive to me because I think a lot of these offices could be repurposed for other uses within the real estate space. And even if they are not, at a certain point, this thing could get so beaten down that it's a good bargain. And I like a good bargain as a value shopper in the stock market. So I want to go into some general thoughts about spin-offs. Then I'm going to go through these three, just a few bullet points on each. And I have a lot of in-depth slides that I want to share on JNJ and Kyndryl as well. So we're going to get through all of this today in the video. Before I do that, just wanted to let all of you know, check out my Patreon. I'm going to include in the pinned comment below a link. I have a lot of amazing bonus content over there on Patreon. I'm sharing all kinds of stock trades over there that are exclusive to Patreon. They're not available elsewhere. On the corner tier of Patreon, I'm actually including some bonus crypto content and new videos as well, new bonus videos. So check it out. Let's keep going. As you can see in front of you right now, these are some of the things I think about at a high level when I'm looking at spin-offs. So one thing I want to say overall at a high level is I take a Peter Lynch style strategy. I've done all right with some of these spin-offs, and so I think a lot of people are quick to sell them. I am not so quick to sell them. I'm a long-term buy and hold forever investor, and so if I get a spin-off, first thing I want to do is take a step back and really look at it. I'm most likely going to err on the side of not selling. And so that being said, I'm not a huge fan of these splits or spin-offs. The reason is it's more complexity in my portfolio, and honestly, they do tend to unlock value. I got a lot of value unlocked with Raytheon Technologies, Carrier, and Otis all splitting apart. That being said, I prefer for the value not to be unlocked in terms of capital appreciation, because when the value is not unlocked, as someone who's always accumulating stocks, I get better value on the money deployed. I tend to keep spin-offs. I think sometimes spin-offs can present value. I think Viatris is an amazing value. I continue to buy that one. That was a spin-off from Pfizer. I especially like spin-offs when everyone hates them, like Viatris, and dumps their shares. I think there's a knee-jerk reaction in the dividend investing community just to sell these spin-offs. I like to take a contrarian approach. I think sometimes spin-offs can create value and feed the ego. I am proud of my positions in Otis and Carrier. They've done tremendously well. I expect to hold all of my spin-offs, and I've really gotten over the concept of a quote-unquote clean portfolio. I used to think, hey, I'm going to get my portfolio really well organized. I'm only going to have so many positions. I don't want to have too many positions or too much clutter. Long story short, I've gotten over that. I've realized that I'm going to have a lot of positions in my portfolio. They're all going to play a role. I am building an indestructible dividend portfolio here, and part of that includes spin-offs. And honestly, the way I keep it clean is staying focused with my capital deployment. That's why I'm buying Johnson & Johnson every week, because I can keep it clean by really prioritizing the most core positions. But if I have a ton of ancillary positions and it's a little messy, I'm okay with that. I've gotten over that kind of issue, if you will, with portfolio cleanliness in terms of having not so many positions. I want to keep going. As you see in front of you right now, here are a few thoughts about Johnson & Johnson. And so with Johnson & Johnson, one of the things that I like about this split into two companies is it'll take 18 to 24 months according to management. This is going to give me some time to really buy shares regularly so that when it does split, the positions, both of the resulting companies, will be really huge, because it is, I take a lot of pride in J&J being the largest position in the portfolio. And once it splits into two, obviously both of those companies will be smaller. And so to keep the main J&J the biggest in my portfolio, and even bigger than it is now, I need to keep buying. This is going to be similar to my United Technologies strategy that I had. Shout out, by the way, if you've been around since those United Technologies days when I was talking about that company, please go ahead and smash the like button if you're an OG subscriber from the old days. And if you're not, that's okay. Go ahead and click that subscribe button with the notification bell. I always have new content on the way. Anyway, as you see in front of you right now, one of the things that I think Johnson & Johnson is doing, in addition to unlocking value, is honestly separating legal risk. My hypothesis around this entire split up ties into my last few dividend investing videos. I'm not quite sure which video I talked about it. I think it might have even been the last one, where J&J has had one step forward with their case in Oklahoma, but they had one step backward with their talc powder case. And my hypothesis is one of the reasons they're splitting is to separate legal risk amongst two entities. So if one of the entities has a major legal judgment against it, it won't affect the other entity and vice versa. Now, I do think they're probably going to unlock some shareholder value here. Is this really good for dividend investors, this huge capital appreciation? I don't think so, because I'm buying for the cash flow, but it's nice. It feeds the ego. I'm going to hold both and manage it as one company going forward once it does split in 18 to 24 months. But in reality, it's going to be difficult to do that. I'll always prioritize the main entity. And will it remain my top position? It's going to be more difficult after the split, but I think it'll be possible because the revenue is roughly 17% consumer, 55% pharma, 28% medical devices. I'm just going to assume after all is said and done that maybe the consumer company will represent 20% of the market cap, 80% with the pharma medical devices. And so I'll just keep adding, and I'm going to have two big positions in the portfolio. And my goal, as I said before, is 10%. 10% of my portfolio. After the split, I want the main company to represent. So I'll just keep pressing forth. That's the miracle of dividend investing. I'll let my dividends reinvest. I'll let the dividend increases play their role. And I'll keep deploying more capital brick by brick. So I'm going to get into more about J&J later, but before that, let me talk about some high-level thoughts with Kyndryl. So as you see in front of you right now on the screen, Kyndryl is the spin-off from IBM. I like the fact that Kyndryl is now free to work with partners like Microsoft and even Amazon. They weren't before when they were part of IBM. I'll give you the example and I'll show you a screenshot in a minute. But what's great is Kyndryl now has the ability to help clients get on the Microsoft cloud, get on the Amazon cloud. Before they were tied to just the IBM cloud. I love the fact that this thing is hated. Kyndryl stock has done nothing but go down. I like that it's trading at an attractive price by revenue, price divided by revenue. I dislike that they're losing money, but I think that will change over time. I dislike that they lack a dividend, but I think this could change over time. I'm holding my Kyndryl shares, and I'll add a little bit more just for fun. If it dips enough, that is. And so that's what I'm doing with Kyndryl. I'm going to get into more again in terms of slides in a minute. By the way, if you're watching the video today and you own these stocks or you're thinking about owning them, let me know. Let the community know in the comments section below. Let's get a discussion going. I would love to hear what all of you think. Do you think, Ian, you're going the wrong direction, or Ian, you're doing the right thing? I would love to know either way. Now, in terms of Realty Income, as you can see in front of you right now, I have just a few thoughts. I will probably follow up in a future video with more depth on this one, but I could only include so much content in the video today in terms of just time and keeping these videos digestible for the viewer. But basically, I need to research more, but I'm going to hold on to the spinoff. I'm excited that everyone hates the office space industry right now. I hope ONL, or Orion Office REIT, I hope it absolutely tanks. That is my goal as a dividend investor, as a value investor, to look for these little opportunities in the stock market. That's my favorite part of it all, is buying when everyone else is running or discovering something before others discover it. It is so much fun. That is the game of it all. Now, I want to get into a few screenshots about Johnson & Johnson. So as you can see in front of you right now, the first one is just the overall split press release. And what it shows is Johnson & Johnson announces plans to accelerate innovation, serve patients and consumers, and unlock value through the intent to separate their consumer health business. So they're going to spin that consumer health business into a separate company. And so that news came out on November 12th, just a few days ago. I wish I could have had this video even sooner for you. I know a lot of you have been waiting for it. So thank you for hanging in there. Now, what I want to share is a pertinent quote from a CNBC article that came out about this very situation. As you can see in front of you on the screen right now, this is from CNBC. And I thought what was so helpful about all of this is basically in the second paragraph, it's yet to be named consumer products company will also inherit litigation stemming from lawsuits over claims that its Johnson's baby powder causes cancer, allegations the company has vehemently denied. And so First and foremost, my heart goes out to anyone facing any kind of medical decision or medical issue, and I leave it up to the court of law to decide who's in the right, who's in the wrong, and to get through all of the technical details as it pertains to these types of allegations. I'm just sharing the news here in front of you right now, but my heart goes out to anyone facing any kind of medical issue, and I'm not trying to say one way or the other who's in the right or the wrong. I just don't know. I think the court will have to look into it and decide. But what I am saying is I believe Johnson & Johnson may be separating into two companies to try and shelter risk, because in this baby powder case, for example, if there is any kind of judgment against J&J, I think they're going to try and protect the pharmaceutical and medical devices company. And honestly, I think that's one of the reasons the price earnings ratios are so low. Now, I want to go through some quick slides from J&J's annual report that helps support my strategy and how I'm looking at this going forward. So as you can see in front of you right now, there's a cool little pie chart from the 2020 report, sales by segment. And you can see the darkest shade of gray is pharmaceutical, 45.6 billion. The middle shade of gray, medical devices, 23 billion. And you can see consumer health, 14.1 billion is the lightest shade of gray. You get a sense of the magnitude of each of these various businesses. Now, I want to go into a summary of these in terms of a tabular format for you as well. So as you can see in front of you right now on the screen, I also pulled this from the 2020 annual report, and you can see income before taxes. And so you can see actually consumer health in 2020 lost money. This may have been related to the pandemic. You can see that pharmaceutical had a nice income before taxes of 15 billion. You can see medical devices, 3 billion. So it also shows the segment sales of each of these as well. So you just get a sense of what's going on with the company. As I had previously stated in my summary from before, I think if you were just to take kind of market cap right now and it were trading as two companies, I think 80% of the market cap would go to J&J, which would be pharmaceutical medical devices, maybe 20% of the market cap to consumer health. Just if I had to guess about it all, that's where I'm at with it all right now. I just want to keep adding, so by the time the thing does split, I've got big positions in both. I love this company. It's going to continue to be my number one favorite company in my dividend stock portfolio. Let's keep going. As you can see in front of you right now, I'm now going to go through Kyndryl in a little bit of detail. Kyndryl had a very helpful deck on the website. And even before I do that, though, first a press release. So this is the press release with Microsoft just on November 12th. Basically, Kyndryl announced that they're now partnering with Microsoft and they're going to be able to work with companies to bring them onto the Microsoft cloud. And this is really awesome because as the biggest IT consulting company in the world by revenue, Kyndryl is now unlocking all of these doors that were closed when it was just able to sell the IBM cloud. And so I don't know if spinning off Kyndryl really helps IBM, but I think spinning off Kyndryl really helps Kyndryl because now they can really expand upon what they're offering and the value that they bring to potential customers. And so I think that's really, really good news. One of the reasons that I feel good about holding Kyndryl right now. Let's keep going. As you see in front of you right now, I want to go into some details from the deck from Kyndryl's recent investor presentation. Kyndryl at a glance, you can just see in front of you right now, they're recognized as an industry leader. You can see what they do. They offer services, consulting for cloud, for core enterprise, digital workplace, application data and AI, network and edge, security and resiliency. Every single company in the world needs these kinds of services right now. Most companies out there in the world cannot fully handle all of these types of things internally. Therefore, my take is that Kyndryl has a very bright future in terms of helping companies around the world get up to speed and stay up to speed on these types of important initiatives. Let's keep going. As you can see in front of you right now, I have another slide to share. This is some noteworthy facts about Kyndryl. I love this because everyone hates it now, but when I go through this deck, I actually see some really promising things. They're in 63 countries. Boy, they manage 25,000 plus SAP and Oracle systems, 9 million automated actions per month, 90,000 employees, 10 years of or more experience on average, mainframe capacity. They have backup jobs going daily, virtual servers. They are able to process 6 trillion instructions per second, 2 million terabytes of storage. This is not just some startup, if you will. This is just not some inexperienced tech company. This is a broad scope of services, processes. And what I would say also is it's not just they're doing one-time consulting jobs here and there. Kyndryl is in lockstep with a lot of these companies. Companies trust Kyndryl to back up their data. Companies trust Kyndryl to run automated processes and to build custom automated processes for them. And so it's one of these things where it's an ongoing relationship. And so now that they're free from the IBM being kind of stuck just to IBM technologies, I think it unlocks some value for this company. Let's keep going. As you can see in the next slide in front of you right now, here's some investment highlights. And so I would say the first one is great. The separation doubles their addressable market. Of course it does. They're not tied just to IBM technologies anymore. I would say they have a competitive advantage from their people, data, intellectual property. That goes without saying. They're trusted long-term partner of 75% of the Fortune 100. And so on and so forth. You can see here just a few investment highlights of the company. The best one is the second to last point, honestly, strong financial characteristics with a $19 billion in annuity-like annual revenues. And so $19 billion in revenues, but it's trading at a $4 billion market cap. Something doesn't add up there, and that tells me as a long-term value investor, there's some value here. I think everyone is discounting this thing. Now, am I going to go crazy and make it a huge position? No, it's going to be an ancillary position of an ancillary position, but hey, I'm happy to hold it. I'm not just going to run away from something where I see value. As you can see on the screen next in front of you right now, they derive benefits from being the world's largest IT infrastructure services provider. You can see right there, 19 billion revenue. Their next biggest competitor, DXC, is at 9.5 billion in revenue. And so it's just fabulous to see the scale of this thing. It's amazing. I have some logistics around the spin-off, as you can see in front of you right now. They did the distribution on November 3rd after the market closed. Regular trading on the new stock began November 4th. And so since then, it's done nothing but go down in value. One of the things that I would say all the way at the bottom that I think is really important is IBM is retaining 19.9% of the post-spin equity of Kyndryl. And so IBM still owns and has exposure to Kyndryl as well. And so that's just something to keep in mind. I think that's a smart strategy on IBM to keep exposure to Kyndryl. Because if Kyndryl unlocks a lot of value, does really well, they're going to still be able to participate in that upside. As you can see in front of you right now on the next slide, I want to go through their investment grade credit profile. And so I guess what it's saying is the net debt, when you subtract the debt from the cash, is $1 billion. And in fact, the reason I was including this slide, and I think I'll get more into it later as I go through the balance sheet, is this company was not stuck with a ton of debt like Viatris. I think when IBM spun it off, they actually set them up for success in terms of their balance sheet. So we will get more to that in a minute, but I was just showing that high level slide, I think, to give a sense of the disparity between cash and debt. So let's keep going. Check it out right now. I want to go through the income statement really quickly. I know I'm doing a huge Kyndryl deep dive today, but I just think it's fascinating. And whether you own Kyndryl or not, even if you sold it, the fun part of all of this is just going through these numbers makes me better, at least as a dividend investor. And hopefully everyone at home following along enjoys this kind of thing too. You can see all the way on the right, I'm just going to look at the pro forma. This is for the year ended December 31st, 2020. Revenues were $19 billion. Costs of services were pretty high. Obviously, they've got a lot of costs to cover. And total costs and expenses, quite frankly, were higher than revenue. And this right here is what's spooking all of the investors. They're losing money. But what I believe is now that they're split apart from IBM, they can really focus on this particular business. The revenue is there. And if that kind of revenue is there, I am sure they're going to be able to unlock value. They're going to be unlock value and drive a profit and eventually pay a dividend. But until then, the balance sheet is really strong to weather that transition from being unprofitable to profitable. And as you can see in front of you right now, in fact, I want to show that balance sheet. So check it out. And let's look all the way in the right-hand column at the pro forma. This is the unaudited balance sheet as of June 30th, 2021. You could see the cash there that was on that slide previously, just about $2 billion. You could see also, though, their total current assets are about $5 billion. You could see they've got a lot of property and equipment. You could see that goodwill, it's not too high. That's a good thing. And I would say total assets there is $13.798 billion. Now, in terms of liabilities, you can see short-term debt, only $94 million. You can see that total current liabilities are less than total current assets. That's a good thing. It's only $3.5 billion. Now, long-term debt, you can see it's only $3 billion. I don't think that is extraordinary or anything crazy here. And so I was okay with that. You can actually see total liabilities are $10 billion. And so they have a positive book value, positive shareholders' equity, which quite frankly is right around where it's trading. If you take the 13.8 billion in assets and you take the 10.1 billion in liabilities and you calculate the difference, that is not too dissimilar right now from where it's trading on a book value basis. And so basically this company is trading right now as if it were just going to go out of business. And I certainly don't think they're going to go out of business when everyone in the world needs these kinds of services to get their businesses up to speed. And honestly, things like security, you cannot skimp on that. And so many businesses out there are not even prepared for the next frontier of what's happening on the internet and with Web 3 around the corner as well, with decentralized applications. And so that's my thoughts on Kyndryl. Am I so excited about this? Is it a core position? Of course not. Let me know, everyone, what you think in the comments below. And if you enjoyed the video today, please do go ahead and smash that like button. Please also go ahead and subscribe. It means the world to me, and I have new videos on the way all the time. And if you want even more of this, you want to see the types of trades that I'm making all the time, I actually, believe it or not, bought a non-dividend stock today. It is a rare exception, but I did that, and I shared that with my corner patrons today because it's a crypto bonus related content. It's a crypto related publicly traded company. And so go ahead and check out the pinned comment below for more information on my bonus content over on Patreon. I love you all. I really appreciate you tuning in today. It means the world to me. I hope you enjoyed the video. Before I go today, in terms of a full disclosure, I do own the companies mentioned today. I am long Johnson & Johnson, ticker JNJ. I am long IBM, ticker IBM, Kyndryl, ticker KD. I am long Realty Income, ticker O, Orion Office, ticker ORL, I believe. I am also long Pfizer, PFE, Viatris, VTRS. I am long Raytheon Technologies, RTX, Otis, OTIS, and Carrier, ticker CARR. I am long all of those companies in my personal dividend stock portfolio. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. It's possible to lose a ton of money in the stock market. I love you all. Thank you so much for watching. I'm just sharing my personal journey here on YouTube for fun and entertainment. I'm going to see you in the comments below, and I'm going to see you in the next video.